Massive amounts of liquidity has been leaving the markets, which has historically been an indicator for market direction. As the Fed raises interest rates and tries to refill its bank account at the same time, that takes money away from the markets, leaving it no option but to sink. And in the last 25 years, we've also never seen the stock market rally during the inversion of treasury yields, which may also be a hint towards market direction. Welcome back to the channel. I hope all of you are doing well. Now, if you're brand new here, what we try to do on this channel is to try to simplify the complicated and complex markets that we have in front of us. Now, today we're going to be talking about the relation between liquidity in the markets and why that's so important and how that can be a precursor for the direction of the markets. Now, what we have in front of us today is the S&P 500, which is this blue line, and then we have the net liquidity from the Federal Reserve in the red line. Now, the net liquidity is basically the amounts of money in the markets that allow the markets to operate as smooth as they do. Now, before we jump into the analysis of the charts, I want to jump into the importance of market liquidity and why you need to understand it first. Now, think of it like this. Injecting liquidity into the financial system increases the availability of funds for market participants, buyers and sellers such as you and I, retail, institutional, whatever. Now, this can also lower borrowing costs, facilitate lending and investments, and improve market liquidity, which makes it easier to facilitate trade. Now, when there's ample amounts of liquidity, it becomes easier for investors to buy and sell securities and assets as of sorts, now contributing to a smoother market function. This is why market liquidity is so important, because it helps the stock market and all markets run more smooth. Now, before we go into what's happening today, let's actually go back into the past and talk about all these massive moves in market liquidity and what happened in the markets. Now, the first one that I want to start with is the global financial crisis. Now, the market liquidity indicator doesn't go back that far, so this is the first point that we're going to start. And what I have marked up on our chart right now is that you can see that during the global financial crisis, the S&P 500 was continuously falling. Then what happened is that obviously the Fed stepped in and put in a bunch of liquidity into the markets to help it from going even further to the downside. Now, you can see that indicated by this yellow line. As soon as market liquidity was injected, you could see that just a few months later, the market actually bottomed out right around this point, and then we actually started to rise. Now, we can see this happen all throughout the markets, but I just want to bring up the most important points. Now, you could see this happen once again on November of 2015, where market liquidity was all the way up here, basically at all-time highs. And as market liquidity started to drop, as we saw the same for the S&P 500, where the S&P 500 actually ended up dropping around 10% in that same time frame when market liquidity was leaving. Now, this is something that we might be seeing more of today, where you can see market liquidity has been dropping for a good amount of time. Right around here, the red line continuously dropping from January of 2018 to March of 2020. Now, you can see that the S&P 500 was somewhat consolidating, but still going to the upside. But as market liquidity was continuously falling to the downside as there was less money in the system, you could see that pre-pandemic, this is where the market actually crashed to fall back in line with market liquidity. And then we had what we saw during the global financial crisis, where massive amounts of liquidity were pumped into the markets once again, as you could see indicated by this red line. And then what we had was the S&P 500 actually start to rally with that. And you could see how well the S&P 500 correlates with net liquidity, because again, if you follow the money, then you will be able to see where we're going into the future. Now, as you could see, as net liquidity continues to drop, so does the S&P 500. Now, what we're getting here is a massive divergence. As I take away this yellow line, you could see that what's happening is that the S&P 500 is actually rallying to the upside and has been since the start of the year, whereas right now, since June of 2023, just last month, net liquidity is actually leaving the markets. Now, this is very important because, just in case none of you are aware, the debt ceiling crisis was a very large talk within the United States. And one of the things that people were worried about is how low the Treasury balance got. We got all the way down to around $44 billion. Now, what we're looking at right now is the U.S. Treasury's general account. Think of this as their general bank account for the United States, allowing the Treasury to make payments on stuff and to also pay out. So whenever this balance gets low, that's very scary for the Fed. And so what we've been doing is that we've been refilling the treasury account ever since the debt ceiling crisis. As you could see right around here at the beginning of June to basically today, we've refilled it from 44 billion to 400 billion. So as more money goes into the bank account, there's less money available into the markets. Think of it like yourself. If you're putting more money away into your savings, you have less money to invest. And what we're seeing once again is a 2018 style net liquidity where we had less net liquidity coming into the markets. And then what happened is that the market actually reverted back to where net liquidity was all the way down here. And so what we're getting right now again is a divergence where we're having money leaving the markets, but the markets have not caught up yet. Now, one indicator that I wanted to look at that I think is really important to understand is the comparison between the S&P 500 and the 2-year to 10-year yield spread. Now, what's really important is that you could see indicated by these white lines is that whenever we come out of the inversion, whenever this yield comes out of it, that's when the S&P 500 actually performs its worst. That's when we see a massive drop in the markets, as you could see over and over and over again here in the 80s and the dot-com bubble, the global financial crisis. Whenever we come out of our inversion, which you could see down here in this orange line, that's when the S&P 500 actually does the opposite and drops in the markets. Now, again, a big reason for this is because whenever there's an inversion of the 2-year and the 10-year yield bond spread, that means that a recession is likely to happen, and it has been an accurate indicator, being 100% correct over the last 40 years. And so why would this time be any different? As we can see, we are currently deeply inverted at this point. And so you can only imagine that if we follow the trend or follow what history has told us, if we come out of this inversion, the next likely possible outcome is for the S&P 500 to follow to the downside. This also comes at a time that we've raised our percentage points in terms of federal funds rate at the highest and the most aggressive time in history. If you look at the past times before we've hit these recessions, right? Before the global financial crisis, this is how fast we raised rates. Before the pandemic, this is how fast we raised rates. Before the dot-com bubble right over here, this is how fast we raise rates. All of these massive recessions, we did not raise rates as fast as we did today. And so that begs the question, what is going to break next? Because with the Federal Reserve raising rates as fast as they have, we are still below the federal inflation compared to federal funds rate. As you can see in history, if we look at the blue line is the federal funds effective rate. Now the red line is inflation. For inflation to come down, typically in history, the federal funds rate has always been above the red line. As you could see right here, whenever inflation gets out of hand, they raise the federal funds rate, and that's what pushes inflation back to the downside. As you could see right over here, that is currently not the case. So there are really two things that need to happen. We need to continuously raise the federal funds rate in order to get it above inflation, or we need inflation to come down even more. But again, one way to do that is to slow the economy down, which again pushes it into more recession probabilities. So at the end of the day, while we've been talking about this for a long time and you've always seen these warning signals all over, it's starting to seem like it's all catching up now at this point. Now what we're seeing again is divergence in market liquidity with the S&P 500. And at the end of the day, you just have to remember this one thing: follow the money and you'll understand where the markets are going. And what we're seeing right now is we're seeing money and liquidity leave the markets, which means if history repeats itself, which it often does, the market should follow where the money is going, which is to the downside. Now, if you guys enjoyed this video, make sure to subscribe and like for more updates. And until the next video, we'll see you guys then.